simple finance system that I talked about in episode 8 of the Profit podcast with Paul Campey. Inside there, Paul mentioned this webinar that I did for the Profit trainers. It was a big 2-hour-long webinar talking about various business concepts and stuff that I've done over the years. And as part of that, I outlined this super simple finance system that I'd put together to make the systemizing of my business finances much easier to deal with, and so that a lot of decisions were made ahead of time, and so that I could better understand the growth of my business and knowing where my money was going and what it was for and things like that. So I want to run you through this system now. Only the Profit trainers have access to the full webinar, but I wanted to give you a snapshot of what we covered within that, just to give you an example of what this looks like visually and where the money goes with an example that I've got for you. So in its simplest form, this system relies on 3 accounts. You've got a business current account, a personal current account, and then a tax account, which may be in the form of a business savings account, so that those two are linked together. And what we're going to do here is predetermine where our money is going to go ahead of time, so that then when we get paid, we know where to move it to. And that's the idea around systemizing it, is that a lot of the decisions are actually made for us ahead of time. So let's have a look at this in terms of an example. All the money is going to get sent into your business account. Now, to give you some context behind this, here at Profit, we help trainers set up their businesses in a way that means their clients pay them at the start of every month ahead of time for the month's training that they're going to get that month. So at the start of January, that client is paying for January sessions up front via standing order. And all of those trainers' clients are doing that. So they know that by the 1st, 2nd, 3rd of the month, depending on whether it falls on a weekend or something or not, they already know what they're being paid for that month ahead, which makes things very, very simple. And the fact that all of that money goes into the business account means that, number one, it's all above board and there isn't loads of like cash changing hands and things like that. But number two, it's also very easy to track. It's very easy to see what your turnover is, what your revenue is, what profit you're making, because all that money is centralized into one place. Once you make those things simpler to understand, you will take the time to look at those numbers more and make judgment calls, which is also very important when you're running a business. So all the money comes into the business account, and then we're going to filter it into a couple of different places. Number one, we're going to send some over to your personal account, which is essentially the wage you're going to pay yourself. And then number two, we're going to pay it into your tax account so that you know what you're setting aside each month, so that when it comes to tax bill time, you've got that pot of money there that's built up, ready to spend on that expense that you know is coming. So you might as well prepare for it. The third thing we're going to do with that money is allow some of it to build up in your business account. So it's literally just going to sit there in your business to build up over time, build a bit of security around your business and be there if you need it. So for the purposes of this example, we're going to assume that this trainer is earning £4,000 a month. And that's based on the trainer delivering 100 sessions a month, charging £40 per session, which is something a lot of our trainers are doing here at Profit. A lot of them are doing more hours than that. And again, some of them are charging more than that. But this is just to give you some nice round figures to work from. It makes the maths a lot easier. So this trainer's earning £4,000 a month. That goes into the business account, and all that money is sat there really early on in the month, and they know what they've been paid. Of that £4,000, £1,500 is going to get sent across to their personal account. That's what they've decided to pay themselves ahead of time, based on what they know their living costs are and having enough money to enjoy themselves and things like that. They're then going to portion £500 of that money into their tax account, which essentially is locked away so they can't touch it and they don't see it. So if it's out of sight, it's out of mind. They don't even really notice it going, in the same way that an employed person doesn't see that money that they're paying for tax, because it gets taken away before they even get paid themselves. This leaves us with £2,000 sat in the business account, which is there essentially for general business running costs. So it might be to pay for like your gym rents or license fees, or, you know, any day-to-day stuff that you put through your business as a business expense is going to be coming out of that account. So there needs to be a chunk of money in there to afford that. But as I mentioned earlier on, we are going to aim to leave a chunk of that money set aside each month so that it builds up over time. So again, for the purposes of this example, we're going to aim to leave £250 in that account every month that builds up over time and creates this buffer in the account of a few grand, which essentially becomes your new zero. You know, it might be that you set yourself a target of, right, I want to get that buffer to £3,000. And that's what I'm going to consider zero for that account. So that there is my set point of, if my account starts to drop too close towards £3,000, it's time to rein things in again and build that back up, just to give me that security. Now, based on those figures there, based on the fact that you're leaving £2,000 in there and you're only setting aside 250, that basically means you've got £1,750 each month in that business account to use for business expenses or whatever. If that is way more than you need, it might be that you do one of two things. You either might decide to pay yourself a little bit more. So instead of 1,500, you might pay yourself £2,000 or something like that. Or you might decide that you don't need that additional money right now. So you're going to let that buffer build up more quickly. So it might be that that buffer is building up at a rate of £500 a month instead of 250, just to give you an example there. If you then want to add an extra layer on top of this and start working towards like saving for a house, your first mortgage, a car, something like that, what I would suggest is then plugging in a fourth account that's linked to your personal account. And this is just a personal savings account. Many of you might already have these. It might be in the form of an ISA or just a normal savings account. And what we're going to do there is portion off some of the money that you've paid yourself into a savings account there. So again, just for purposes of this example, I've put £500 there, which is what I was doing when I saved for my first house. So paying myself a chunk of money and then £500 was going straight into savings so that I never saw it. And my partner was doing the same so that we were saving £1,000 a month towards our first home. And that was then going to give us enough money for a deposit to do the house up and then get used to having £1,000 a month going out of our account that was going to cover bills and stuff when we lived together. I think that this is very doable for most PTs that are in the industry because a lot of them are very young, living with parents. They haven't actually got that many financial outgoings. So you can get away with sort of paying yourself a fairly small amount and still setting aside a good chunk of that for savings. And it's a really, really good habit to get into from a young age. Just get used to setting aside a portion of your income into a savings account for purposes of like saving for a big purchase or building wealth or working towards a pension, whatever it is that you want to do in the future. You need to get into the habit of doing that now because it will make it so much easier. The idea is that you do this based on a set percentage. So it might be 20% of my income that I pay myself is going to get set aside into savings. I know that in this example, it's more than 20%, but again, it was just for the round figures and to make it nice and easy to look at basically. The idea is that if you set a percentage, then when you start to pay yourself more, the savings that you set aside grow in line with that percentage. So if you pay yourself £1,500 and set aside 20% of that, if you then start to pay yourself £2,000 a month, it should also still be 20% of that, and the savings should go up in line with that. So this is just to give you an example of that simple financial system that myself and Paul discussed. I do think it comes across a lot better when you can see it in a visual format. So I'm just going to run through it with you again, just to quickly go over what we talked about. £4,000 comes into the business account. We portion some of that into your own personal account for your own wages. Some of it goes into the tax account, ready for the tax man coming along to take that from you. And then a portion of money is left in the business account each month. You can decide how much of that you want to leave in the account, but it should be more than enough to cover all your business expenses and leave a buffer within that account that can build up over time. If you're paying yourself enough and you've got something to work towards within your personal life that you want to save towards, I would then recommend a personal savings account in there to build that money up as well. So you've got these little pots of money that are building up everywhere, and you're able to still enjoy yourself on a decent level with the money that you're paying yourself into that personal account. Now, the information that I've just gone through within this video is by no means financial advice. I am not in a position to give financial advice, and I am not qualified to do so. It is purely an example of what I did with my own finances and how I set up my business to afford to A, run a business and survive the first few years, B, pay myself enough money to enjoy life, and C, save for my first home with my partner so that we could, get a deposit together and live together. This is how I went about doing it. And this is the system that Paul Campey was referring to in our podcast. So I wanted to share that with you. That's all for today. Hope that's been useful for you. Please feel free to leave any comments in the video below if there's anything else that you want to know about. And make sure that if you haven't done so already, that you check out the Profit podcast, as there's lots more information like this on there that's going to be very useful to those of you out there running fitness businesses or businesses of any kind. So yeah, check that out. Catch you later.